Assalamu alaikum. Welcome to lecture 14 of financial reporting. This is IAS 36 impairment of assets. So in this lecture we are going to go through the objective of IAS 36, when to test for impairment, annual impairment test, indications of impairment, impact on your accounting estimate, impairment test for an individual asset, performing an impairment test, fair value less cost to disposal, value in use, recognizing an impairment loss and reversal of an impairment loss. Then in cash generating unit, we have to define what is cash generating unit, identifying a CGU, assets of CGU, recognizing an impairment loss for a CGU and reversal of an impairment loss on goodwill. Now, then we are going to conclude with the syllabus, summary and technical articles. So the main objective of this lecture is to guide you in recognizing impairment losses. So in under IAS 36, when to test for impairment, we are going to go through A, testing of individual asset, B, testing of CGU. Okay. Now, objective of IAS 36. IAS 36 is concerned that your assets are not overstated in a statement of financial position. So it requires the value of your asset. Okay. This impairment is required when your value of an asset is less than its carrying amount. Okay. So the carrying amount must be written down immediately because the asset is impaired. That means the value of the asset went down. That is known as impairment. So IAS 36 refers to the value of an asset as its recoverable amount, and it prescribes how this is measured. Now, the requirement to recognize an impairment loss where an asset is impaired reflects one concept in your accounting. This I've explained you in conceptual framework, that is prudence concept. Financial statements are prepared on prudence concept, where you do not overstate your assets and income and you do not understate your expense and liability. So based on that prudence concept, we are being cautious so that we do not overstate our asset. That's why we have to recognize an impairment loss when your asset is impaired. What is impairment loss? The amount by which your carrying amount of your asset or CGU is more than its recoverable amount. When your carrying amount is more than the recoverable amount that your asset has been impaired, you have to calculate the difference known as impairment loss. But if it's the other way around, your carrying amount is less than your recoverable amount, then your asset is not impaired. Okay. But in your exam, you will always be given a situation. If they wanted to test your IAS 36 knowledge, they will always give you asset which has been impaired. Okay. Now, IAS 36 is providing guidance on identifying impairment and accounting for them. Remember, before you start accounting or measuring your impairment, you first have to identify whether impairment have actually taken place or not. If your asset has impaired, good, carry on with the rules of IAS 36, measure it. But if it's not impaired, you don't have to go further. Okay. And this applies to all your assets, also including your subsidiaries, associates, and joint ventures, which we are going to cover under group accounting. But if there is a specific standard which is covering the impairment, then it will be covered by those specific standard, not IAS 36. So these are few standards which will be covered. If that asset is impaired, it will be covered according to that standard, not IAS 36. They are your inventories. If your inventories are impaired, it will be covered under IAS 2, not the rule of IAS 36. Next, contract asset, your IFRS 15, revenue, right? We may recognize revenue under IFRS 15. Okay, so contract asset, because it's an asset, inventory, because it is an asset, they can be impaired. But those impairment are not dealt here. Third, deferred tax asset, IAS 12. So IAS 2 and IFRS 15 I have covered. You can watch my lectures in my FR playlist. You can access the FR playlist by clicking on the I button that is presented to you on the right hand side on the top of your screen, or at the end of the video, link will be given to my playlist. But deferred tax asset I have not covered yet. I have yet to cover financial asset in the scope of IFRS 9, which will be covering. Then your investment property measured at fair value, which will be accounted under IAS 40. I have done it. Biological asset, Measured at fair value less cost to sell, it will be measured according to IAS 41 that also I've covered, and non-current assets or disposal group held for sell IFRS 5. This I've covered. This was the previous lecture, lecture 13. So this, except this few standards, all the other standards will be dealt, if they're impaired, will be there according to rule of IAS 36, except the 7 standards. Now, annual impairment test. When to test for the impairment? See, some asset, whether there is an indication of impairment or not, you have to test annually for the impairment. Okay. So these are the following assets that has to be tested. These are the following intangible asset. They are intangible. Okay. You have to test annually for impairment. Doesn't matter whether indication of impairment is there or not. Number one, those intangible assets with an indefinite useful life. What is the meaning of indefinite useful life? There is no foreseeable future. This I have covered under my IAS 38. Next, those that are not available for use yet. Intangible assets that have not been available for use. You have to test annually. Next, goodwill acquired in a business combination. Goodwill is also an intangible asset. Okay. So this 3 asset, doesn't matter indication of impairment is there or not, you have to test annually for impairment. Apart from this 3, all the other assets, you have to first see whether there are indicators of impairment or not. Okay. And this impairment test for this assets can be performed anytime during a year. But when you're doing it anytime during a year, make sure every time you do at the same time. Other assets within the scope of IAS 36, you should test if indications of impairment exist. So, indications of impairment. At the end of each reporting period, you have to assess whether there is an indication that your asset could be impaired. And if an indication exists, your entity should estimate the asset's recoverable amount. But what if the indication does not exist? That means it's good, your asset is not impaired. So you don't have to do anything. Just sit. IAS 36 is giving you 2 types of sources, 2 types of indicators which says your asset might be impaired. One is your external source of information, the other one is your internal source. We'll go through both of this. Okay. Now, first is external sources of indicators. So first, external means external, outside your entity, something beyond your control, which you can't control. So you have observable indications that the asset value has declined during the period, significantly more than you would have expected as a result of the passage of time or normal use. Next, there are significant changes with an adverse effect on the entity occurred during the period or will occur in the near future because of technological, market, economic, legal environment in which the entity operates. Market interest rate or other market rates of return are increased during the year. So because this is increased, it will affect your discount rate that you will use to calculate your value in use. Higher discount rate means value in use will be less. Okay. So your recoverable amount, it will decrease your assets recoverable amount more. The carrying amount of your net asset of the reporting entity is more than its market capitalization. So all these 4 are external indicators of impairment. Now let us go to the internal sources of impairment. Evidence of obsolescence or physical damage, significant adverse changes in the extent or manner in which an asset is used or expected to be used, evidence from internal reporting that indicates that economic performance of an asset will be worse than expected, or operating loss or maintenance costs will be higher than budgeted. Now, indications of impairment and sustainability issues, the third part. See, because of the current focus on sustainability, climate change, and achieving net zero, this is giving you an additional indications of impairment. Okay, that means you have to now recognize more impairment loss. So, for example, the loss is restricting you to use vehicles which is emitting which is having high emission, and it is giving you a reward to use electrified models. What does it mean? It means for the vehicle fleet that is owned by the transport and other companies, they are impaired. That means your vehicles are impaired for the transport industry if you are using a high emission cars. Equally, properties in a geographical location can be impaired if they are affected by climate change or they are suffering some extreme weather event. That means your asset is impaired. Now, impact on accounting estimate. When there is an indication that your asset may be impaired, this can indicate that your remaining useful life, your depreciation or amortization method, or your residual value for the asset you have to review and it needs to be adjusted, even if no impairment loss has been recognized for the asset. This all IRA estimates, remaining useful life, depreciation, amortization, residual value. This also will change if indication exists of impairment. Okay. Now, finally, we have finished the indication. Now we are moving on to performing an impairment test on individual asset. This is easy. Okay. An impairment test, you have to determine your recoverable amount and you have to compare. So what does impairment test means? Basically, you have to compare your recoverable amount with the carrying amount. And if your carrying amount is more than the recoverable amount, asset is impaired. So what is the meaning of recoverable amount? Recoverable amount is the higher of your fair value less cost to sell and dispose, fair value less cost of disposal and value in use. Same, both for an asset or a CGU. CGU part we are going to cover later after we finish for the individual asset. Okay, but the method of calculating impairment loss is same for both CGU and individual asset. Next, fair value. This we know from our IFRS 13, the price that you would have received to sell an asset in an orderly transaction between market participants at a measurement date. And value in use, the present value of your expected future cash flow that you expect to derive from the use of the asset or CGU. Now, so value in use means what is the value of that asset if you keep that asset in the business and use it. And fair value less cost of disposal means what is the asset's fair value if it is not kept in the business. Instead, if it is sold. So recoverable amount is this. All this you have to remember for your impairment. Your recoverable amount is higher of this two, and this you have to compare with the carrying amount. If recoverable amount is less than the carrying amount, impairment has occurred. Only this part you have to remember in full IAS 36. Okay. Now, if there is an indicator asset is impaired, recoverable amount should be determined for that individual asset by comparing the higher of the two, unless the asset does not generate cash inflows independently. If this is the case, the recoverable amount is determined for the cash generating unit to which the asset belongs. Let's forget about CGU. This we are going to do in section 4. Let's just focus on individual asset that has been impaired. Okay. It is not always necessary for you to determine both your fair value less cost of disposal and value in use if your recoverable amount is higher than the carrying amount. Okay. So if either of this amount, that is value in use or fair value less cost of sale, if either of this amount is more than the carrying amount, that means asset is not impaired. You don't have to estimate any other amount. You just have to find one, either fair value less cost of disposal and value in use. If one of them is higher than carrying amount, you don't have to find the other figure. Or there is no reason to believe that asset's value in use is materially more than the fair value less cost to sell. Okay. When an asset is held for a disposal, the value in use will consist mainly of the net amount that you net amount to be received from the disposal of assets. See, when you are holding an asset for selling, the value in use will only be one cash flow. That is the amount that you will receive when you sell that asset. Okay, because then there is no use of finding the value in use. You can't find the present value of the future cash flow. That is value in use for an asset by keeping that asset, because you're going to sell it. Once that asset is sold, you're not going to get any future cash flow from that asset. Okay, so future cash flow from continuing use of that asset until disposal are likely to be negligible. If you are holding that asset for sale, then any other cash flow that you are receiving by keeping that asset until you dispose are not relevant. You can ignore them. Okay, only the disposal amount that you are going to receive from the disposal of the asset you can take as your value in use. Now, example 1. So there are 3 situations with 3 different figures. Let's do this. Where carrying amount is 1000 in each case, but your recoverable amount will be higher of value in use and fair value cost of disposal. So in this case, 900 versus 1050, higher is 1050. So your recoverable amount is 1050. In the second scenario, Fair value is more than the value in use. So 980 is a recoverable amount. In the third scenario, value in use is more than 925. So 960 is your recoverable amount. First stage is that. Second stage, compare this with the carrying amount. You see, in the first one, carrying amount is less than the recoverable amount, so no impairment. Second, there is an impairment because recoverable is less than carrying. The difference 20 is the impairment loss. And so your carrying amount you will reduce to 980. That's what has been written in the commentary section. Third one, the difference is 40. So impairment loss is 40. And you will write down your asset to 960. Now, fair value less cost of disposal. Fair value we have measured in accordance with IFRS 13. You can see my lecture number 2. That is conceptual framework. Next, cost of disposal are identified in IAS 36. Cost of disposal means any cost that are directly attributable for disposing that asset, but it excludes any interest expense and income tax. Examples include legal cost, stamp duty, and cost of removing the asset. If any of this cost is given to you, you have to deduct from your fair value because they are cost to sell. Now, cost that has already been recognized as a liability, you do not deduct them in measuring fair value less cost of disposal because this cost, examples of costs which are not cost of disposal includes your termination benefit. Remember, you can't deduct them from your fair value. They are not your cost of disposal. And your cost associated with reducing or reorganizing your business following the disposal of an asset. These two costs, if it's given, they are not to be deducted from fair value. Now, example 2 will help you to understand which cost you have to deduct from disposal, fair value. So it's about rent, operating a leased premise, owns a bottling machine situated in a single factory unit. Bottling machines are sold periodically as a complete asset. They have given a value that they are going to sell it for 100,000. They have charged a fee of 1,000 for providing this valuation. Now they need to dismantle the asset and ship it to any buyer. So dismantling and shipping cost is 5,000. Specialization packaging cost is 4,000. Legal fees is 1,500. Now tell me, what is the sale price? 100,000. From this 100,000, what are the costs you can deduct? A. Dismantling and shipping 5,000 you can deduct. Special packaging 4,000 you can deduct. See, 5,000, 4,000 they have deducted. And also legal fees 1,500 you deduct. And this is your fair value less cost of disposal, 89,500. But what about this 1,000 for providing valuation? The the professional valuer's fee is not included in the calculation because it is not directly attributable cost of selling the asset. This cost is not directly linked to selling the asset. This cost you would have incurred even if you would have not sold this asset. But this cost, like shipping, special packaging, legal fee, all this you have incurred because you are going to sell this asset. That's why you are deducting from the sale price. You understand now? Now, value in use. Determining the value in use involves estimating your future cash inflows and outflows that you would have got by continuing the use of the asset and applying an appropriate discount rate. Because you have to find the present value, you need a discount rate. Values in use differs from fair value. How? Value in use is entity specific. For each entity is different because it's your own estimate. But fair value is not entity specific. For everyone is the same. Now example 3, value in use. Okay, so it's about Dove holding a patent on a drug. Patent expires in 5 years. Okay, they are expecting the demand will grow at 5%. So now experience shows that competitors flood the market with some generic versions and the patent is no longer protected. What does it mean? Impairment has taken place. So they do not expect the patent to generate significant cash flow after 5 years. The net revenue from the sale is 100 million and the discount factor is 15.5%. So now this is your cash flow 100 and you will use the discount factor 15.5% and you will grow the cash flow by 5%. So you have all the necessary information for you to find the present value. So what are you going to do? In one column, you're going to write this time from 1 to 5 year, then cash flow for the 5 years, discount factor is 15.5% and the present value. Let us do. First year is only 100, which you will multiply by 5% growth, 1.05, 105. This you will use the discount factor in 1 year. So 105 into the discount factors. That is 0.866, you will be getting a present value of 91. So 105 becomes 91 present value. Next, 100 into 1.05 to the power 2, because this is year 2, this is year 3, this is year 4, this is year 5. So it's the same calculation, 100 into 1.05 to the power 1, 2, 3, 4, 5, and you get the cash flow. Once you get the cash flow, you multiply with the discount factor given here and get the present value and add all the present value for the 5 years. This is your total value in use, 379. Okay. Now, cash flow projections. Let's talk something about that. Your projections should be based on reasonable and supportable assumptions that represents the management's best estimate of the set of economic conditions which will exist over the remaining useful life of the asset. Greater weight should be given to external evidence. See, when you're making the projections, it has to be reasonable. It can't be some unreasonable, you don't have any evidence or no supportable assumptions, no. Then, they should be based on the management's most recent financial budgets, at least maximum of 5 years, unless you can justify a longer period beyond the period covered by your most recent budget. Okay, cash flow should be extrapolated using a steady or a declining growth rate unless you can justify an increasing rate. Growth rate should not exceed the long-term average growth rate for the relevant product, industry, or market unless you can justify a higher rate. Now, estimates of the future cash flow should include your projected cash inflows, including your disposal proceed, because your disposal proceed is also a cash inflow for you, and projected cash outflows that are necessary to generate cash inflow from continuing the use of the asset in its current condition. Estimates of the future cash flow should exclude the cost of financing, as this is accounted for in your discounting and taxation. See, the tax that they are giving you or the discount factor that they are giving you, that discount factor, they have considered this cost of financing in that. They have already considered, adjusted, and they have given you the discount rate. So no need to take interest in your future cash flow. You have to exclude it. Now, discount rate. Your discount rate that you have to use should be pre-tax. Remember, in your exam, you might be given both the type of discount rate, post-tax and pre-tax. You have to take, when you're finding the value in use, the pre-tax rate. Okay. So it should reflect two things, the time value of money and the risk that is specific to the asset. Now, example 4. Based on discount, which discount rate to use. So it's about Marwood conducting an impairment test on their production line. Discount rate is 8.5%. This is selected to calculate the value in use. So this rate reflects its pre-tax cash flow, risk specific to the production line and risk specific to the wasteland, that is the country, and the current market assessment of the time value of money for the period until the end of the production. So the rate does not reflect the risk for which cash flows included in the value in use calculation have already been adjusted. Okay. Now, recognizing an impairment loss. So impairment loss incurs when your recoverable amount is less than the carrying amount. So you have to recognize impairment loss. In the case of an impairment loss, okay, see, if your asset has been measured at historical cost, impairment loss will be recognized in the operating category of your statement of profit and loss. If your asset is property, plant and equipment, and in the investing category, if your investment property, okay, if your asset is in investment property measured using cost model. Next, if your item of property, plant and equipment measured using the revaluation model is impaired, your impairment loss will be treated in the same way like a downward revaluation. That's why you have to go to my IAS 16 revaluation model and you have to see how downward revaluation are done. Okay, it's there. You can go and watch my IAS 16. So firstly, into your OCI, to the extent that it reverses any revaluation surplus relating to the asset, and then the extra impairment loss you will recognize in the operating category in your statement of profit and loss. This is the same for downward revaluation also. So same impairment loss also you will treat it like that. How you are treating the downward revaluation. After an impairment, remember, after impairment, the assets carrying amount less any residual value, you are going to depreciate if it's a tangible asset or amortize if it's an intangible asset over its remaining useful life. Now, example 5. So three situations are given. In the first situations, assets are carried at historical cost. So your carrying amount is 100, no doubt. Recoverable amount they have given as 80. So since recoverable amount is less than the carrying, there has been impairment. The difference is the impairment, which is 20. But this 20, because since it is recorded at historical cost, will be recognized in profit and loss. So 20 debit. First situation is very easy, straightforward. Okay, but mostly in the exam they might give you the second situation or the third situation to test, because first is very easy, but still you have to know because it might come as a part of section A questions, right? Objective test questions it might come. Then situation 2, historical cost is 100 but it has been revalued to 50. So see, you will write the carrying amount at 150, the revalued amount, and then compare with the recoverable amount because you are using the revaluation model and you are going to compare with the recoverable amount. So you see the difference is 25. So this is the first time you are doing the revaluation. So 25. So this 25, because it has been revalued, unless they do not tell you the type of asset, whether it's investing, intangible, you always have to assume it's an asset under property, plant and equipment. IAS 16 will apply, right? So revaluation surplus, where do you recognize under IAS 16? In OCI. So that's why we are going to debit in OCI 25. Okay, we are going to recognize this 25 here. Now, situation 3. Historical cost is 100, but it has been revalued to 150. Same situation, 150. But this time your recoverable amount is 95. Same situation, 2 and 3 are same situation, same this thing, but only the thing is recoverable amount has been much lower now. So tell me what's happening. This situation you have to be careful. Check the difference. If you check the difference, it's 55. But can we recognize 55 straight away in profit and loss or OCI? Straight away? No, we can't do that. So what do we do? So this difference of 55 we are going to record in two separate places, OCI and profit and loss. Why two separate places? Because it's a revalued amount that has been impaired. Okay, so first we'll take the difference with this. See, if you compare the historical cost with the recoverable amount, historical cost is 100, recoverable amount is 95. The difference is 5. So that 5 will go to P&L and the balance 50 will go to OCI because that's because of the revaluation. So when that is impaired, only that part will go to OCI. So if we check the revaluation amount, that is the difference 100 and 150. So only the 50, only the revaluation will go to OCI. Okay. So if you compare 150 with 95, the difference is 55. But out of that 55, when you compare the historical cost 100 with the recoverable amount, it's 5. So that 5 will go to P&L and the balance 50 out of 55 will go to OCI because it's a revalued amount that has been impaired. Now, reversing an impairment loss. Once an entity has recognized an impairment loss, it should carry out a further review. They should not stop there. They should carry out a further review in the later years if there is an indication that asset may be further impaired or impairment loss that you have recognized in the prior year, now it has reduced. So when it has reduced, the second point, how do you account for the reversal? An impairment loss can only be reversed if there is a change in the estimates that used to determine the recoverable amount since your last impairment. So what is impairment all about? It is all based on your estimate. You have estimated your recoverable amount will be so and so, which you have compared with the carrying amount and got an amount. But in the later years, your estimate might be different because now new information came. or maybe your recoverable amount might be more or less than your estimate that you have done before. So now what you have calculated as impairment might no longer remain an impairment. So there's a change. So you have to account for that change. That is called a reversal of impairment loss. So in this case, the carrying amount of your asset will be increased and you will recognize a gain in your profit and loss. The increased amount, when you're increasing the carrying amount, you cannot exit beyond a limit. There's a ceiling. Beyond that, you can't increase your carrying amount when you're reversing an impairment loss. So, which is the carrying amount? What is the amount? Maximum is your carrying amount that you would have been determined if the original impairment loss had not been recognized. That means what would be the amount of your carrying amount if there would have been no impairment loss in the first place? That up to that amount you can increase. Of course, your carry amount would be net of amortization or depreciation. You would deduct amortization or depreciation, that carrying amount, but before deducting impairment loss. Any increase above the ceiling is a revaluation and it must be treated as such. Now, accounting for a reversal. So a reversal of an impairment loss is recognized in profit and loss immediately unless your asset is measured using IAS 16 revaluation model. So in case IAS 16 revaluation guidance applies and the reversal is recognized in profit and loss to the extent that an impairment loss was recognized in profit and loss. Okay, any excess is recognized as other comprehensive income. Now, example 6. Reversal of an impairment loss. So the machine has a carrying amount of 100,000, useful life is 10 years. They have tested it for impairment and recoverable amount is 80,000. So 180 recoverable loss is 20,000. 2 years later, they have calculated the recoverable amount as 94,000. So now you have to compare your carrying amount with this recoverable amount. For that, you have to know what is your carrying amount in 2 years' time. This carrying amount is in the starting 100,000. So we'll do that. How are you going to do that? See, your carrying amount will be reduced down to your recoverable amount, which is 80,000. So this 80,000 is now your carrying amount, but you have to deduct the depreciation. You are going to depreciate this amount now. So how are you going to depreciate? In 2 years' time, 2 years later. So you have to take the depreciation for 2 years out of 80,000 and deduct it. So it would be 80 into 2 divided by 10 because total year is 10 years and you are taking it for 2 years and on 80. And then you deduct it from 80 and get the carrying amount. So in 2 years time, the carrying amount is 64,000. Now compare the 64 with 94. There's no impairment now. So the impairment loss of 20,000 that you have calculated before, now you have to reverse it. But you can't reverse the entire 20,000. Okay, there is an amount up to how much you can reverse. So the maximum amount at which the machine can be measured without revaluing it would be, for example, see, this carrying amount went down to 80,000 because of impairment. But if it was not impaired, your carrying amount would have been 100. Then you would have deducted your depreciation from this 100,000, isn't it? So 100 minus 100 into 2 divided by 10 because you are taking depreciation for 2 years on this 100,000. Then your amount would have been 80,000. You see? So the maximum amount your machine can be measured without revaluing would be 80,000. So what's happening out of this 20,000? Therefore, only 16,000 of the previous impairment loss. See, if you compare the two, 64 and 80, maximum is 80. You can reduce. So the difference, that is 80 minus 64 is 16. Therefore, out of the 20,000, 16,000 of your previous impairment loss can be reversed and it is recognized as your other operating income in your statement of profit and loss. Please understand. Okay. If you compare it, 64 and 80,000, the difference is 16,000. So only 16,000 you can reverse out of this 20,000. Because only up to this much you can reverse. Your value of the carrying amount could only be up to 80,000. Beyond that, you can't. So for you to reach from 64 to 80, you can reverse 16,000. This reversal part is often asked in exam, and this is the tricky area. Okay. See, accounting for impairment loss is easy, but when it comes to reversal, you have to be little careful. Now, the last part of this lecture is cash generating unit. All this while we have been impairing the individual asset. So what is the definition? How do we account for it? Let's see. If there is any indication that asset may be impaired, your recoverable amount must be estimated for the individual asset. However, it's not always possible. Okay? Because if your asset does not generate cash inflows that are largely independent of those from the other assets. So in this case, you have to find the recoverable amount for your cash generating unit to which the asset belongs. A cash generating unit is the smallest identifiable group of assets that generates cash inflow that are largely independent of the cash flow from other assets or group of assets. That means sometimes very difficult to say that this asset is impaired or this individual asset is creating that impairment. So what do? You group the assets together. Okay, you find the smallest identifiable group of assets, but that group of assets should be able to generate cash inflows independently from the other assets. Then only you can say they are part of a CGU. Then you find the recoverable amount of the CGU. So identifying the lowest aggregation of assets which generates largely independent cash inflows, this requires a judgment. Management have to consider various factors. For example, they have to go by the product line, individual location, regional areas to make the decisions about continuing or disposing of assets. Now, sometimes it is possible to identify cash flows which stem from a specific asset. You can say that because of this asset, this is the cash flow. But this cannot be earned independently from other assets. You do need the help of other assets. In such case, asset cannot be reviewed independently and it has to be reviewed as a part of CGU. In your exam, you could be given an individual asset or a CGU. So CGUs you have to identify consistently from period to period for the same asset or type of assets unless a change is justified. The carrying amount of the CGU should be measured on a consistent basis with the recoverable amount, and both should include the same asset as well as same liability if it's relevant. Now let us see the two examples. Example 7, CGU dry dock. So DD owns a dry dock with a large crane to support its activity. Okay, the crane could only be sold for a scrap value, and cash inflows from its use you cannot identify separately from all of the operations directly connected with the dry dock. So in this case, it's not possible for you to get a recoverable amount of the crane because its value in use cannot be determined. What happens? So DD has to estimate the recoverable amount of the CGU to which that crane belongs. In this case, you have to find the recoverable amount of the dry dock as a whole. You are not able to find the recoverable amount of the crane alone. Next example, example 8, airport. So, Aero operates an airport that provides services under contract with the government. The agreement is giving a minimum level of service on domestic road in return for a license. Assets devoted to each road and the cash flows from each road can be identified separately. Therefore, the domestic service operates at a significant loss. Because Aero does not have the option to curtail the domestic service, the lowest level of identifiable cash inflows that are largely independent of the cash inflows from other assets are those generated by the airport as a whole. So airport is the CGU. Okay. Now, assets of a CGU. The carrying amount and the recoverable amount of a CGU must be determined on a consistent basis to include the same assets. A CGU will not include liabilities. because they can be settled independently. So we are only focused on the asset part. In some cases, your assets might be shared more than one CGU. So the carrying amount of these assets has to be allocated on a reasonable and consistent basis. Examples of shared assets which needs to be allocated includes goodwills acquired in a business combination and corporate assets, for example, head office or centralized market function, because this is used by many other assets. Now, goodwill acquired in a business combination. So for goodwill that we have acquired in a business combination, they must be allocated to each of the acquirers CGU that are expected to benefit from the synergy. Regardless of whether asset or liabilities of the acquirees are assigned to those CGUs or not. Each CGU of CGUs to which the goodwill is allocated must represent the lowest level within the entity at which goodwill is monitored for internal management purpose. Okay, so this is, you have to allocate the goodwill to the CGU, and to allocate it, it has to represent the lowest level within the entity that is monitored by the internal management, where you are monitoring the goodwill. Next, and it is not larger than an operating segment. Operating segment is dealt under IFRS 8, but in your financial reporting, we are not going to cover IFRS 8. It will be tested in your SBR. Now, these allocation requirements are necessary so that it prevents you from offsetting the impairment of one CGU against the increase in value in another CGU. You might be having more than one CGUs. Okay. For example, more than one group of assets. You can't offset the loss of one CGU, the impairment loss of one CGU against the increase in value of another CGU. That you can't do. Okay. But it is possible if your impairment was only assessed at the entity level, but usually it is not. So once the goodwill has been allocated to CGU, that CGU you have to test for impairment, at least annually or as soon as the indicators of impairment of goodwill or CGU. Now, different CGUs will be tested at different times for impairment. Okay, but some or all of the goodwill that is allocated to CGU that was acquired in a business combination during the current year. So that's why you have to do the testing for the impairment for CGU before the end of the current year. That is for goodwill. Now, for corporate assets, what is corporate assets? Assets other than goodwill, which contributes to your future cash flow of both CGU that is under review and other CGUs. The distinctive characteristics of corporate assets are, see, corporate asset is something that on its own they cannot generate cash inflow. Okay. Next, their carrying amount you cannot fully attribute to the CGU under review. Examples like head office or divisional buildings, central information system or research center. On their own, they can't generate cash inflow. They need the help, okay, of another thing. They are part of the system, they are component. So corporate assets are usually allocated to CGUs on a pro rata basis in relation to their carrying amount of the other assets of CGU. So definitely with questions you will understand CGU better. Now, how do you recognize an impairment loss for CGU? For asset, we know, compare the carrying value with the recoverable amount. But for CGU, it's the same process. The only thing is this is not for an individual asset. Now it is for CGU's carrying amount. You are comparing with CGU's recoverable amount. Okay. So here also, if your recoverable amount is less than the carrying amount, there is an impairment. But the problem for CGU is where does the credit entry goes in the statement of financial position. So the impairment loss has to be allocated between all assets of the CGU in this order. First, against goodwill that is allocated to the CGU. If any, then pro rata on the other assets of the CGU within the scope of IAS 36 based on their carrying amount. Now, when you are allocating an impairment loss, the carrying amount of the individual asset, you cannot reduce below the highest of those three figures. First, its fair value less cost of disposal, its value in use, and 0. So you can't, that means it cannot go to negative. So that means the impairment loss that is allocated to an asset in a CGU is limited. So your excess impairment loss you have to allocate against the other assets of the CGU on a pro rata basis. Now, activity 1. So let us go through activity 1. It's about a sunflower paying 2,800 whose main activity is refuse collection. They are having 4 refuse collection vehicles and a local government license without which they cannot operate. At 1st Jan, the fair value of the license is 500. At 1st Feb, one lorry crashed and it is write-off. Because of its reduced capacity, the recoverable amount is 2,220. You have to allocate the impairment loss. Ignore depreciation from 1st Jan to 1st Feb. So now how will you allocate the impairment loss? This is a very good question. So now let us see. See, very important when you're writing CGU. There are two things. One, goodwill you have to separate from the other assets. Okay, and there are 2 dates. One is on 1st Jan, as you can see here, then the impairment loss, and then the 1st Feb. Okay, so now if you see, that you have paid 2,800. So this is the total 2,800 here on 1st Jan. Okay, then see, they told at 1st Jan the fair value of each lorry. How many lorries are there? There are 4. Of each lorry and license is 500. So 500 into 4. Total is 2,000. 500 into 4. That's how we get this 2,000. Okay. And total is 2,800. And out of that, intangible asset, if you see, the value is 500. This is the license is your intangible asset. Okay. Each lorry, 500 into 4. 2,000 and license is 500. Now, the balance. The balance is your goodwill. Because you have paid 2,800, you have paid more than the amount. So the difference between what you have paid and your asset, you see here, 2,000 is the amount of lorry, intangible asset is the license, and 2,800 you have paid. So the difference between this, the balancing figure is your goodwill. 300 is your goodwill. Okay. Now let us go to the impairment. Okay. So your license have not been impaired. They did not say anything. So license will remain 500 only. What is impaired? One is your goodwill and one is your lorry. Okay. So an impairment loss of 500 is recognized first for the lorry which is crashed. They told one lorry is crashed and one lorry is for 500. So we are going to deduct that 500 and then your amount becomes 1,500. Okay. Because its recoverable amount can be assessed individually. So your lorry will no longer form part of the CGU that is formed by the 4 lorries and the license because it is not going to contribute the future cash flow. The remaining impairment loss 80 is attributed to goodwill. So remaining impairment loss. Now see, how do you know the remaining impairment loss? Very easy. What did they say? What is the recoverable amount? 2,220. See, this is the amount they have given. So 1,500 is the amount of your lorry. 500 is your intangible asset. The balance 220. So to get this 220 from 300, 80 is the impairment loss. Now you see, if the assets in activity 1 had included current assets, this would not be allocated any of the impairment loss as they would already be measured at current value. Okay. If it was current asset, you cannot allocate any of the impairment loss against the current asset because this is non-current asset. That's why you're able to do it. Okay. You see, they already told that on 1st Feb, your recoverable amount is 2,220. Now, activity 2. So following on from activity 1, at 22 May, they have increased the government has increased the interest rate. So the value in use decreased to 1,860. Fair value decreased to 480 because there was an increase in interest rate. Now the demand for lorries was hit hard by the increase in rates and the selling price was affected. You have to show how the above information would affect the carrying amount of the asset. So let us go here. Now it was from Jan to Feb before in activity 1. Now it's from 1st Feb to 22 May, and in between you will be having impairment loss. So you have to remember the figure for 1st Feb. It is 225,500. Okay. Now they have told that the value 1860. Okay. And they told fair value less cost of disposal of the license have decreased to 480. And value in use is 1860. So here, when you go to the answer, this is the amount, recoverable amount 1860, and they have already told for intangible assets it's 480. So this is the balancing figure 1380 for the lorries. Okay, so you can get 120 easily. Once you get this is the balancing figure, and if you get 480, it is 500 minus 480, the difference 20. So if you get this 20 and 120, now to get the goodwill, there is a working. Let's see this working here. Okay, this 220 is allocated to goodwill to reduce it to 0. Already we have 220. We'll allocate the impairment loss 220 to reduce it to 0. Okay, the balance 140. Balance of 140. Okay, must be prorated between the remaining assets in proportion to their carrying amount. So what is the total impairment loss? You have to simply calculate the difference between your carrying amount and 1860. So if you check the difference, this is the amount and this is 1860 is 360. Okay, so out of this 360, 220 is for goodwill. You will bring it to 0. The balance of 140, then the balance of 140, you can't straight away put 140. You should know how much impairment will go for intangible and how much will go for lorry. This you will prorate based on the carrying amount of both intangible and lorry. So you have to use the ratio of the remaining assets to each other. So now you have to find the carrying amount here on first 5 you have to see. So what is the total of intangible? Not this total because you don't have goodwill. You only have intangible and lorry. The total is 2000 and intangible asset is 500 out of 2000. That means 25%. So you have to apply 25% of 140, that is 35. So 35 should be allocated to the intangible asset. However, this would reduce its carrying amount to below its fair value less cost to sell. It is not allowed. If you reduce it by 35, you can't do that. If you do that, it will reduce it below its fair value less cost of disposal. See, what is the fair value less cost of disposal? It's 480 and this is 500. So you can't reduce it to 35. If you do that, it will go more than 480. It can't go below this. This is fixed. You can only reduce up to 20. Okay. So the maximum you can allocate is 20. What about the remaining 15? If 20 you deduct out of 35, 20 only you can reduce by intangible asset. The remaining 50 must be allocated to the lorries. But how much? You can't just put 15 from lorries. Therefore, the amount allocated to lorry is 120. How did we get 120? If 25% is for intangible asset, the balance 75 will go for lorry. So 75 into 140, that is this, and plus this 15 that has not been allocated to intangible asset. So you have to add the 15 later. But first take 75% of 140. Do not take 140 plus 15 into 75 or not 75% of 15. 15 is separate. So it's 120. And you take 120 here. Okay. You should know this allocation, by the way. This is the question which is very frequently tested, giving you CGO and getting you the allocation. Now, reversal of an impairment loss on goodwill. Any impairment loss that has been recognized for goodwill, you cannot ever reverse it later. But you can reverse an impairment loss for a CGU allocated to the assets of the CGU, not goodwill but other assets. So the carrying amount of the individual asset, you should not increase them above the lower of recoverable amount and carrying amount before the impairment loss had been recognized. Any excess reversal beyond this limit has to be reallocated to the other assets of the CGU on a pro rata basis. Now, that's it. So we are in section B of the syllabus, 3 impairment of assets. Second one was your non-current assets that we have finished. So under impairment, we have defined, calculated and accounted for impairment loss and including the principles of impairment test in relation to goodwill. Then we have accounted for the reversal of impairment loss on individual asset. We have identified circumstances that may indicate impairment to assets. We have gone through internal external factor, describe what is meant by cash generating unit and the basis on which impairment loss has to be allocated, and allocate the impairment loss to the assets of a cash generating unit. Now let us summarize the lecture. We have started by saying intangible asset with an indefinite life, those that are not available for use, and goodwill. This 3 intangible assets must be tested for impairment annually, irrespective of indication of impairment. Next, your indicators of impairment could be external or internal and has to be assessed annually. If this exists, you have to estimate your recoverable amount of the asset or the recoverable amount of the CGU. Your accounting estimates, useful life, depreciation method, residual value, this all are your accounting estimates. This also you have to review if there's an indication of impairment. Recoverable amount is the higher of fair value less cost to sell and value in use. If your fair value less cost of disposal or value in use is more than the carrying amount, there is no impairment. Fair value is dealt according with IFRS 13. Value in use will reflect the amount and the timing of your future cash flow that you will discount using the pre-tax discount rate. Any impairment loss that are measured at historical cost must be recognized in profit and loss immediately if recoverable amount is below the carrying amount. An impairment loss on a revalued asset is recognized in the same way as a revaluation decrease. The impairment carrying amount is depreciated over the asset's remaining useful life. An impairment loss is reversed if recoverable amount later increases more than the carrying amount because of the changes in estimates. A CGU is the smallest identifiable group of assets that generates cash inflows independently from other assets. Carrying amount and the recoverable amount of CGU has to be determined on consistent basis. Shared assets and goodwill has to be allocated to CGU that benefit from them. An impairment loss that reduces the carrying amount of the CGU assets. Okay. So allocation is first against goodwill, then against other assets based on their carrying amount. The carrying amount cannot be less than the higher of the fair value less cost of disposal, value in use, and 0. An impairment loss in relation to goodwill you can never reverse. There are no technical articles for this lecture. So thank you for watching, and I shall see you in the next lecture, that is IFRS 16 leases. So with this, I have finished almost all those assets that relates to non-current assets, whether tangible or intangible. And also the impairment of asset is over. Now we'll be moving on towards other areas like your liabilities, your leases. So the next one will be leases. Now make sure that you do questions on impairment, because impairment is a standard which is asked almost in every exam, whether in SBR or whether in FR. It's always tested. No matter what standard you are given, impairment will be asked with along with another standard. For example, it could be asked under IAS 16, IAS 40, IAS 38, IFRS 5. It could be asked under any standard. So you have to be prepared for impairment. And there are lots of questions in your past paper based on impairment. So make sure that you do them from your revision kit. Thank you for watching.